One of the many questions that novice investors have is when to start investing. What should you invest in? When it comes to financial advice, who should you heed or ignore? If investing is so important to your financial future, why must it be so challenging? The good news is that it's not necessary. These 12 straightforward tips for novice investors demonstrate how to make the challenging process of learning how to invest simple. Before starting, don't forget to like and subscribe to our channel for more future updates. So, let's start. Number 1. Start now. The biggest hurdle for a beginner investor is getting started. The greatest time to start investing is now, says Nicholas J. Scheibner, a wealth management advisor with Barron Financial Group. He cautions against waiting until the perfect time to enter. Begin immediately, and keep building it. He also suggests that novice investors begin their first year assuming a loss on their investment. Recognize that losing money on an investment is occasionally to be expected, and that it doesn't always indicate that something went wrong. It probably suggests the exact opposite, which is that you should make more purchases when they are on sale. Number 2. Don't let the media scare you. The biggest piece of advice Andrew Langdon, a registered financial planner and founder of 5 Points Financial Planning, would provide to new investors, is to understand that the media and you as an investor have completely different agendas. The goal of the media is to attract viewers, which they typically do by coming up with exciting headlines. According to Langdon, if your goal as an investor is to raise your wealth over time, you may achieve this by focusing on factors like time horizon, risk, costs, and taxes. According to study, people who don't try to time the market and don't make many adjustments to their portfolio will do better in the long run. When you come across stories warning of the impending stock market Armageddon, try to keep a clear head and make decisions based on your investing plan, not the newest headlines. Number 3. Focus on your savings percentage. Just like spectacular headlines, poor portfolio performance has the potential to mislead new investors. It's easy to doubt your investing decisions when your portfolio suffers a loss. Yet stock market losses are unavoidable. Rather than focusing on your portfolio's performance, Ben Hakima, a certified financial advisor at Illuminate Wealth Management, suggests focusing on your savings rate. He asserts that the two most important elements of success for long-term investors are continuing to invest and saving adequate money. Although your investments are not under your control, you do have some control over how much money you save. According to Hakima, beginners will be in an excellent position to succeed if they continually focus on maintaining or increasing their savings rate. Number 4. Set investment goals. The first stage in creating an investment strategy is identifying your investment objective. Rob Williams, Vice President of Financial Planning at Charles Schwab in Denver, suggests that you put a monetary amount next to each of your short, medium, and long-term goals. A trip to Greece might be a short-term goal for next year, while saving for a down payment on a house could be a medium-term goal. Having defined goals is a great approach to keep yourself inspired to keep investing and saving. According to him, your comprehension of how to invest for the duration of each aim is aided. Number 5. Use goals to determine your time horizon. How long you want to hold onto your money will be greatly influenced by the goals of your investments, says Lamar Watson, certified financial advisor and proprietor of Dream Financial Planning. Your time horizon is the amount of time you must wait before utilizing the money you are investing. This might be the most important factor in determining how much risk you can endure. According to Watson, your time horizon needs to be as long as the amount of danger you can tolerate. If your time horizon is 10 years or longer, you can tilt more heavily towards stocks, between 5 and 10 years. You should have a good mix of stocks and bonds. Under 5 years, you shouldn't have any stock exposure, and within 2 years, you should only have cash and cash substitutes like certificates of deposit. Number 6. Get to know your risk tolerance. Only invest with as much risk as your investment goal and risk tolerance will tolerate. You shouldn't raise your level of financial risk just because you can. It doesn't follow. Your level of risk will be determined by your allocation to stocks and bonds. More stocks are related to higher risk. The allocation you choose will depend on your financial goals, says Mike Hennessy, founder and CEO of Harbor Crest Wealth Advisors in Fort Lauderdale, Florida, is comparable to the speed at which you decide to drive your car. He claims that as no one wants to move from 65 miles per hour to 35 miles per hour in a matter of seconds. Your allocation should remain largely constant throughout time. But it should fluctuate as you approach your investing goals. Number 7. Start with broad-based investments. After deciding whether to invest, the next critical choice new investors must make is what to invest in. According to Williams, the abundance of investing possibilities may make a decision challenging. Broad-based mutual funds and exchange-traded funds, which combine the money of many people to buy a variety of securities, are fortunately a simple way to get started. Prior to filling up the gaps with funds that correspond to your selected allocation, decide on the percentages of cash, bonds, and stocks that you wish to invest in. Number 8. Keep your costs low. Despite the fact that you have no influence over how well your investments perform, you do have control over the cost of your investments. Amity Financial Planning's founder and CEO, Michael Pappas, counsels beginning investors to pay special attention to an investment's costs. Actively managed funds frequently have expense ratios of 0.67% or more, whereas index funds typically have expense ratios of 0.15% on average, according to Morningstar's most recent fee research. Over time, these escalating costs can chip away at the return on your investment, claims Pappas. Number 9. Don't be afraid to ask for help. Nowhere does it say that investing has to be a lonesome endeavor. Stacy J. Miller, partner, vice president, and wealth advisor at Bright Investments, asserts that her best recommendation for novice investors is to seek counsel if they are not experts. A financial counselor, who is not only for the wealthy, may help you with any issue you might be facing. Miller cautions, however, to thoroughly vet any advisor, like you would someone who will look after your children. Find out if possible advisors are fiduciaries and about their certifications. Miller advises looking for chartered financial analysts and certified financial planners, since they show years of additional education, training, and skill. Visit advisorinfo.sec.gov to verify their qualifications. Next, learn their compensation and the associated costs of working with them. Number 10. Automate as much as you can. Williams suggests automating as much of the investment process as you can. When everything is set up automated savings deposits, monthly contributions to your non-retirement investment portfolio, and contributions to your retirement account. If there is less work for you to do, he believes, it will be less scary and you'll be more inclined to stick with it. Having stated that, you ought to keep taking part, he advises examining your portfolio at least once a year to make sure your assets and allocation are still in line with your goals. If that's what you want, your thinking should be long-term, he counsels. Avoid overreacting or changing plans as a result of simply short-term volatility, and try to keep a long-term perspective. Number 11. Start thinking about your pension. It's never too early or late to start planning for your retirement. We don't blame you if retirement savings aren't your top priority if you're in your 20s. To take charge of your retirement sooner rather than later, it can be a good idea to start early planning and organize your funds. Checking your state pension and employer-sponsored pension savings now, if you're in your 30s or 40s, could be a wise move. Start by asking yourself some crucial inquiries. Will it suffice for retirement? Is there a method to maximize your retirement income if not? Opening a personal pension, also known as a self-invested personal pension, SIP, may be able to help you increase your retirement savings. You can save as much as you wish for retirement with a personal pension, and any profits you earn are exempt from UK tax. Number 12. Consider diversifying your portfolio. Attempting to reduce your risk is always a good idea, regardless of your investment strategy. By distributing your funds throughout various investment categories and geographical locations, you may diversify your portfolio and reduce the risk of losses. If you put all of your money into one or two businesses, you can get a rude shock if those businesses have trouble. Now, if you purchase a variety of investments of various types such as shares, bonds, and property and participate in several financial markets, the risk that you will lose all of your money will diminish. A diversified portfolio of various investment funds might assist stabilize your account during an economic cycle as different markets rise and fall. Investing solely in certain markets, industries, or businesses can expose you to unforeseen problems that may arise in that area. To minimize potential losses and maximize long-term profits, it is beneficial to invest across a variety of asset classes, locations, and industries. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comment section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.